The American dream of homeownership is officially becoming the American nightmare. For decades, we were told that buying a home is the smartest financial move you can ever make. We were told that renting is just throwing your money away. But as we move into 2026, the math has fundamentally shifted. The old advice from your parents and grandparents is no longer just outdated, it's dangerous. In fact, for the average person in today's economy, buying a home right now could be a $500,000 mistake that traps you in debt for the rest of your life. While the media and real estate agents are desperate for you to sign a 30-year mortgage, the smart money, the elite investors and mathematical experts are choosing to rent. But why? Why is renting suddenly the superior financial strategy? The answer lies in a combination of high interest rates, stagnant wages, and the hidden costs of home ownership that no one talks about at the closing table. Today, we are going to break down the cold, hard numbers. We are going to look at the opportunity cost of a down payment, the reality of the 2026 housing market, and exactly why staying liquid as a renter is the secret to building massive wealth in this decade. If you are thinking about buying a house this year, you need to stop everything and watch this video first. Your financial freedom depends on it. To understand why the buy versus rent debate has flipped, we first have to talk about the true cost of a mortgage in 2026. Most people look at the price of a house, say $500,000, and they think that's what the house costs, but they are forgetting the most expensive part, the interest. With current interest rates, you aren't just paying back the $500,000. Over 30 years, you will likely pay back over $1.2 million. That means you are paying for the house more than twice over. The bank is the one getting rich, while you are left with home equity that you can't even spend unless you sell the house or take out even more debt. When you rent, your monthly payment is the maximum you will pay. When you own, your mortgage is only the minimum you will pay. Between property taxes, homeowners insurance, and the maintenance tax, the true cost of owning is often 40 to 50% higher than the mortgage payment itself. Let's talk about the $500,000 mistake. This comes down to something called opportunity cost. Imagine you have $100,000 for a down payment. If you put that money into a house, it's locked away. It's dead money. It isn't working for you. It's just sitting in the walls of your home. But what if you rented a modest apartment and invested that same $100,000 into the S&P 500 or a diversified portfolio of high-growth assets? Historically, at an average return of 10%, that $100,000 grows to over $1.7 million in 30 years. Even after paying rent, the renter often ends up with millions more in liquid net worth than the homeowner who is house poor and trapped in a 30-year commitment.
The homeowner has a house, but the renter has a fortune. The 2026 housing market is also facing a liquidity crisis. In the past, houses were considered liquid assets. You could sell them quickly if you needed cash. But today, with prices at all-time highs and buyers being priced out by high interest rates, houses are becoming illiquid. If the economy takes a dip and you need to move for a better job or a family emergency, you might find yourself stuck with a house you can't sell for what you owe. As a renter, you have the ultimate power in a volatile economy: mobility. You can pack your bags and move to a better opportunity in 30 days. In 2026, mobility is a form of wealth. The ability to pivot is what separates the rich from the middle class during a recession. By renting, you are paying for the freedom to move, while the homeowner is paying for the privilege of being stuck. Then there is the maintenance trap. Ask any homeowner what happens when the roof leaks, the HVAC system dies, or the foundation cracks. Those are $10,000, $20,000, or $30,000 expenses that come out of your pocket. As a renter, those are your landlord's problems. In the 2026 economy, where the cost of labor and materials has skyrocketed due to inflation, repairing a home has never been more expensive. Homeowners are spending an average of 1 to 2% of their home's value every single year just on maintenance. On a $500,000 home, that's $5,000 to $10,000 a year down the drain. This is money that the renter is instead putting into their brokerage account, where it compounds and grows every single day. Let's look at the psychological side of this. We're conditioned by society to believe that home ownership is a sign of success. We want the white picket fence because we were told it means we've made it. But is it success if you are stressed every month about making the payment? Is it success if you can't afford to take a vacation or invest in your own business because all your money is going into your primary residence? The smart money in 2026 understands that a house is a liability, not an investment. An investment is something that puts money in your pocket every month. A liability is something that takes money out. Unless you are renting out rooms or the house is a multifamily property, your home is a liability. By renting, you are keeping your liabilities low and your investment potential high. There is also the property tax spiral. Many homeowners forget that property taxes aren't fixed. As the value of homes goes up, so do the taxes. In many states across the U.S., property taxes have doubled in the last few years. You never truly own your home. You are just renting it from the government. If you stop paying your property taxes, see how quickly the government takes your house away. At least as a renter, you know your cost is capped by your lease agreement. You aren't at the mercy of the local tax assessor every year. Now let's talk about the wealth transfer of 2026.
We're moving into a period where the greatest transfer of wealth is happening from those who are asset-heavy to those who are cash-heavy. When the housing bubble eventually corrects, and history shows us it always does, the person with cash and liquid investments will be the one who can buy up assets at a discount. The person with all their money tied up in an overpriced house will be the one struggling to survive. By renting now, you are positioning yourself to be a buyer when everyone else is a forced seller. You are waiting for the blood in the streets to make your move. The buy versus rent calculator in 2026 is broken for most people because it doesn't account for the invisible recession. We are seeing a shift where jobs are no longer for life. AI is disrupting entire industries. In this environment, the last thing you want is a 30-year anchor around your neck. You want to be lean. You want to be agile. You want to be able to move to where the capital is flowing. Homeownership is a 1950s solution to a 2020s problem. It's time to upgrade your financial thinking. So, what should you do instead? First, do the actual math for your specific city. In many major U.S. cities, the cost to own is now double the cost to rent a similar property. If you can rent for $3,000 a month, but it would cost you $6,000 to own, you are essentially saving $3,000 every month by renting. If you invest that savings, you will be a multi-millionaire long before the homeowner pays off their mortgage. Second, change your mindset. Stop looking at your home as an investment and start looking at it as a consumption choice. If you want to buy a house because you want to paint the walls and have a garden, that's fine, but call it what it is, a luxury purchase, not a smart investment. In 2026, the real winners are the liquid millionaires. These are the people who have a 7-figure brokerage account, a flexible lifestyle, and zero debt. They aren't impressed by a big house with a big mortgage. They're impressed by freedom. They're impressed by the ability to say no to a job they hate because they aren't slaves to a bank. The $500,000 mistake is avoidable. Don't let social pressure or a real estate agent's sales pitch talk you into a bad financial decision. The numbers don't lie. In 2026, renting isn't just a lifestyle choice, it's a wealth-building strategy. If you found this deep dive into the 2026 housing market helpful, hit the like button and share this with someone who's about to make a massive mistake. Subscribe to Coin Crush for more updates on how to navigate this invisible recession and build real wealth. Watch this next video where I break down the exact portfolio the top 1% are using to stay rich while the middle class is being wiped out. I'll show you the assets that are actually worth buying in this economy. I'll see you in the next one. Don't buy the lie. Buy the math. Your 10-year clock starts now.